Welcome to another audit walkthrough video from SuperfastCPA. I'm Logan, and in today's video, we're going to be going over Audit Area 2. This is Section D1. This is a remembering and understanding topic. Understand materiality, including qualitative considerations as it relates to the financial statements and related disclosures as a whole. And we're going to be doing that the SuperfastCPA way, which is diving straight into the questions to learn the material. Now, if you don't know much about our strategies, make sure you go to SuperfastCPA.com and sign up for our free 1-hour webinar training. Again, it's free. It's 1 hour, and in that 1 hour, we will teach you the key ingredients to passing the CPA exam so you don't waste months or even years of your time. So make sure you check that out, and after you watch that, you're going to want to learn more, so make sure you also check out becoming a Superfast CPA Pro member. Superfast CPA Pro members get access to the full 10-question versions of these 5-question YouTube videos. So if you like this and you like our other videos and our other products, make sure you become a Pro member because you'll get access to the full 10-question videos so that you can get a little bit more help and a little bit more understanding. Now, with all that, let's dive straight into the questions. Okay, here we are at question 1. Let's just dive straight in. Which of the following best describes the concept of materiality in financial reporting? Okay, let's go through the options. Option A, a requirement that all financial transactions, regardless of size, must be disclosed in the financial statements. Option B, the principle that financial statements should be free from any errors or misstatements no matter how small. Option C, the threshold at which missing or incorrect financial information would reasonably influence the decision of users of the financial statements. Or option D, a rule that only quantitative factors determine whether an item should be disclosed in the financial statements. Now, we're learning about materiality in this video, and if you don't really understand what materiality is, that's okay. We are using these questions to, of course, learn what it is and to learn the rules surrounding it. Now, if you have an idea of what materiality is, that's great. Maybe pause the video and think through these different options. And when you're ready, come back. But if not, let's dive straight into the explanation to start learning. Okay, here we are at the answer C, the threshold at which missing or incorrect financial information would reasonably influence the decision of users of the financial statements. So that's the basic idea behind materiality. And we've talked a lot about materiality all throughout the other videos, but we've never really talked about the definition and really focused on what materiality is. So let's read the explanation. Materiality is a fundamental concept in financial reporting that helps determine whether an omission or misstatement in the financial statements could impact the economic decisions of users, such as investors, lenders, or regulators. Materiality is assessed both quantitatively, and that means there's a dollar amount relative to total assets or revenue, so an actual specific dollar amount, and qualitatively, and that would be things like the nature of the misstatement or regulatory considerations, so things outside of the monetary value. An item is considered material if its inclusion or omission would influence the decisions of financial statement users. So if it influences what people would do just by that knowing that information or not knowing that information, then it would potentially be material. Now, we learned what materiality is. That's just the basic definition there. Let's go to the next question to learn more. Okay, here we are at question 2, and something I always like to point out when it is an option is to read the last part of the question first. So, of course, this won't be helpful if the question is one sentence long, but if there's multiple sentences or multiple paragraphs, you're going to want to read the last sentence first because very frequently it will give you context for what the rest of the question is talking about, and this will help you a lot on test day so that you know once you dive into a question what you're dealing with right off the bat. So let's go ahead and read the last part first. Which of the following statements best describes how an auditor adjusts materiality during the audit process? Okay, so imagine we were on test day. We read that last sentence and we immediately know we're dealing with adjusting materiality. So that's great. Now let's go up to the top. When determining materiality for an audit, an auditor typically establishes an initial materiality threshold based on financial statement benchmarks. So again, which of the following statements helps us know when the auditor is going to adjust materiality during the audit process? So let's go through the options. Option A, the auditor sets materiality based solely on prior year financials and does not revise it once the audit begins. Option B, materiality is established using expected financial results, but may be adjusted if actual financials differ significantly from initial expectations. Option C, once the auditor determines materiality, it remains fixed throughout the audit, regardless of new information obtained. Or option D, materiality is determined at the end of the audit to ensure the auditor's opinion aligns with the financial statement, to make sure the auditor's opinion aligns with the final financial statements. Okay, so again, when are they going to adjust the materiality? Can they adjust the materiality? If you don't know, that's okay. We are using this question to learn. So let's go ahead and dive into the explanation. Okay, here we are at the answer B. Materiality is established using expected financial results, but may be adjusted if actual financials differ significantly from initial expectations. So they can adjust the materiality if they find more information or if the actual financials are quite different. So let's read through this explanation. Auditors establish an initial materiality threshold based on financial benchmarks, such as total assets, revenue, or net income. often using prior year financials as a reference. However, as the audit progresses and more up-to-date information becomes available, the auditor may adjust materiality if the actual financials significantly differ from initial expectations. Adjustments help ensure materiality remains relevant and appropriate for assessing misstatements. Materiality is not fixed from the start, so that makes A and C incorrect, nor is it determined retroactively at the end of the audit, and so that makes D incorrect. So again, materiality can be adjusted, especially if we originally based it off of preliminary things like the prior year financials, and we get better information, then it can be adjusted. Now let's go to the next question. Okay, here we are at question 3. Which of the following best describes the purpose of performance materiality? Okay, let's go up to the top. When setting materiality levels, auditors determine materiality for the financial statements as a whole and may establish lower materiality thresholds for specific accounts or transactions. So again, which of the following best describes the purpose of performance materiality? Let's go through the options. Option A, it represents the overall materiality threshold for the financial statements as a whole. Option B, it is set at the same amount as overall materiality to ensure consistency in evaluating misstatements. Option C, it is a lower threshold than overall materiality used to reduce the risk that undetected misstatements in aggregate exceed materiality. Or option D, it is only applied to transactions related to fraud risk areas. Okay, so if you've never really heard of performance materiality, then you won't know what the correct answer is. But if you've heard about it and you kind of have an idea, maybe pause the video, read through this, and when you're ready to come back, we'll look at the answer together to learn about performance materiality. Okay, here we are at the answer C. It is a lower threshold than overall materiality used to reduce the risk that undetected misstatements in aggregate exceed materiality. Okay, so that's what performance materiality is in a nutshell, but let's read through the explanation. Auditors establish an overall materiality threshold for the financial statements as a whole, and that's kind of like the big idea of what we're talking about in this video, but of course there's other things besides the materiality threshold as a whole. But they also determine performance materiality, which is set lower to provide a margin of safety. Performance materiality helps auditors account for the possibility that multiple individually immaterial misstatements could add up to a material amount in total. By setting performance materiality lower than overall materiality, auditors reduce the likelihood that undetected or uncorrected misstatements, when combined, would exceed the materiality threshold for the financial statements as a whole. In addition, auditors may establish specific materiality thresholds for certain classes of transactions, account balances, or disclosures when those items are particularly significant, such as related party transactions or sensitive accounts like revenue recognition. So again, basically, you are having materiality for the financial statements as a whole, but you also set performance materiality, and you also might set materiality thresholds for certain things like transactions or account balances, such as related party transactions. So there's multiple levels to materiality, but again, you have an overall threshold for materiality, and then you have performance materiality to make sure that a lot of little things don't add up to still exceed the overall threshold for materiality. So with that, we learned a little bit more about materiality in general. Now let's go to the next question. Okay, here we are at question 4. Which of the following scenarios would most likely lead an auditor to set a lower tolerable misstatement for an account in the current audit? So let's go up to the top. Tolerable misstatement is the maximum amount of misstatement an auditor allows in an account balance or class of transactions without considering it materially misstated. Which of the following, again, would most likely lead an auditor to set a lower tolerable misstatement for an account in the current audit? So let's walk through the options. Option A, the account contained uncorrected misstatements in the prior period that were below materiality but still aggregated to a significant amount. Option B, the company experienced strong financial growth, increasing overall materiality thresholds. Option C, no misstatements were identified in the prior audit, so the risk of material misstatement is presumed to be lower. And then option D, the client's internal controls over financial reporting have improved, reducing the risk of misstatement. Okay, so again, we haven't really learned too much about tolerable misstatement, but it's very, it's a part of materiality. And based on the definition of tolerable misstatement we have right there, and then the question that's asked, which one of these is the correct option? Which one of them is going to set a lower tolerable misstatement? Now, if you don't know, or if you can't really think through it, that's okay. We're going to read the explanation, but if you want, pause the video, think through this, and when you're ready to come back, we'll look at the answer together. Okay, here we are. The answer is A. The account contained uncorrected misstatements in the prior period that were below materiality but still aggregated to a significant amount. So let's walk through the explanation. Tolerable misstatement is a threshold auditors set for individual account balances or classes of transactions, ensuring that undetected misstatements do not accumulate to a material level. So it's a little bit similar to performance materiality, but it's for specific account balances. If prior period misstatements were uncorrected and aggregated to a significant amount, the auditor may lower the tolerable misstatement in the current audit to enhance detection and ensure that misstatements do not continue accumulating over multiple periods. By adjusting tolerable misstatement based on prior audit results, auditors ensure that misstatements do not accumulate over time, leading to financial statements that fairly present the entity's financial position. So again, tolerable misstatement is basically the threshold under which, these misstatements can be okay, but so it's tolerated, and a lower tolerable misstatement means that you have less toleration, or you will tolerate less mistakes. So again, a lower threshold for tolerable misstatement means that you are going to accept less mistakes before you start considering things to be material. Let's go through the other options and why they're wrong. Option B is incorrect because an increase in financial statement materiality would likely lead to a higher tolerable misstatement, not a lower one. And again, if materiality goes up, that's actually meaning that there is more room for error before things start being considered material. Option C is incorrect because prior audits without misstatements do not necessarily reduce tolerable misstatement. Risk assessments may change based on other factors. So, it's not just because there was no mistakes in the past. That's not the only thing that's going to affect tolerable misstatements. Option D is incorrect because stronger internal controls typically increase tolerable misstatement as there is a lower risk of undetected errors. So don't get confused by increasing tolerable risk or lowering tolerable risk. Again, if you have a higher tolerable misstatement, that means you can have more mistakes before you start considering things to be material. If you have a lower threshold for that, then that means you are going to accept less mistakes before you consider something material. So, don't get confused by that. Now let's go to the next question. Okay, here we are at question 5. Which of the following best explains why auditors set component materiality lower than the overall materiality of the group financial statements? So let's go up to the top. In a group audit, the group engagement team is responsible for determining materiality at multiple levels. So again, which of the following best explains why they have a different component materiality that is lower than the overall materiality for the group? And you'll understand that as we read through this. So don't worry if you don't know what group or component means in this situation. Let's read through the options. A, to ensure that the component auditors perform more extensive audit procedures than the group auditors. Option B, to reduce the risk that undetected misstatements across multiple components, when aggregated, exceed group financial materiality. Option C, to allow for flexibility in materiality judgments across different components based on auditor discretion. Or option D, to prevent component auditors from issuing a modified opinion on their respective financial statements. Okay, so again, if you don't really know what it's talking about when it's talking about a group audit or about components or component materiality, that's okay. We are using this question to learn that. But if you have an idea, pause the video, come back when you're ready, and we'll look at the answer together. Okay, here we are at the answer B, to reduce the risk that undetected misstatements across multiple components when aggregated exceed group financial statement materiality. So you're seeing kind of a pattern here. A lot of the times when there's materiality that's set below the overall materiality, it's kind of there to make sure that undetected things don't start adding up to be greater than the overall materiality. Let's talk about the explanation. In a group audit, the group engagement team must establish materiality at multiple levels to ensure the financial statements are free from material misstatement. While materiality is set for the group financial statements as a whole, the auditors also determine component materiality, which applies to individual subsidiaries, divisions, or business units. So just to make sure that that's clear, I had this extra explanation right here. A group audit is an audit of a set of financial statements that consolidate or combine multiple entities. So again, often called components. And so the components would be things like subsidiaries, divisions, or branches. So it combines it all into one group. So that's what we're talking about right now. Component materiality is always set lower than group materiality because even small misstatements by the component or at the component level add up and become material when consolidated. By lowering component materiality, auditors reduce the risk that undetected misstatements in multiple components will accumulate to a material amount in the group's financial statements. Additionally, the engagement team may set lower materiality thresholds for specific accounts, transactions, or disclosures that are particularly significant, and we've talked about that before. To further ensure accuracy, auditors also establish a trivial misstatement threshold, which sets a minimum amount above which misstatements must be evaluated for their impact on the financial statements. So we learned a little bit more about materiality there. Again, when you're doing a group audit of a whole bunch of components, each component's materiality is going to be lower than the group materiality because you have to make sure that one component isn't going to affect the materiality or ruin the materiality of the group as a whole. Now, we learned a lot about materiality in general in this whole video. Before we do anything else, let's do one more part of the SuperfastCPA process called pillar topics. Now, the idea behind pillar topics is as you're going through the questions to learn the material, you will notice the things that keep popping up in the questions. You've seen 2, 3, 4 questions trying to teach you about component materiality or about performance materiality or things like that. And you take these pillar topics and write them in your own words so that you know what is most important based on the questions you did for test day. And as you do this each day, you're building your own personal repository of the most important things you need to know for the exam in your own words. Now let's go ahead and look at the pillar topics for this video. Okay, here we are at the pillar topics. Let's just dive straight in. First, let's define materiality again. Materiality is the threshold at which missing or misstated information in the financial statements could influence users' decisions. It involves both quantitative, so the dollar amount, and qualitative, the nature of the item, considerations. And by the way, in the next video, we're going to talk about how to actually calculate or how to actually set materiality. We're actually going to see the numbers, but we were just learning about materiality in general in this video. Now let's talk about adjusting materiality. Auditors set an initial materiality level, and that's often set using prior year benchmarks, and adjust it if actual results differ significantly. This ensures materiality stays aligned with the entity's real financial situation as the audit progresses. Now let's talk about performance materiality. Performance materiality is a lower threshold than overall materiality, providing a margin of safety so that multiple small misstatements don't add up to a material amount. It helps auditors detect combined errors that could become significant. Now let's talk about tolerable misstatement. Tolerable misstatement is the maximum error an auditor allows in a specific account or class of transactions without deeming it materially misstated. It can be lowered if past audits revealed uncorrected errors or higher risk in the area. And let's talk about group and component materiality. In a group audit where multiple entities roll up into one set of financial statements, each component's materiality is set lower than the overall group materiality. This protects against small errors across different components accumulating into a material misstatement for the group. So kind of a similar idea to performance materiality, but now you're talking about it for a group of financial statements. Now with that, we've gone over the pillar topics for this video and the first 5 questions. And remember, we're only going over 5 questions in this video, and SuperfastCPA Pro members are going to get access to the full 10-question video that we're going to post in the members forum. So if you like this and you like our other videos, make sure you check out becoming a SuperfastCPA Pro member, because Pro members get access to, again, the full 10-question versions of these videos and, of course, other things too. So make sure you check that out. And the easiest way to become a Pro member is actually to first go sign up for our free 1-hour webinar training on SuperfastCPA.com. You can watch that 1-hour webinar for free, and we will teach you a lot about how SuperfastCPA works and how to study for the exams. And after you watch that, that will give you the best path to becoming a Pro member of SuperfastCPA. So check out the webinar, check out becoming a Pro member. And with all that, I hope you liked the video. If you did like the video, make sure to like it and leave a comment. I hope this video was helpful, and I will see you in the next video.